Okay, so I decided to use this time to record the section on the formulas. So I started by talking about the Wacc. We know that the Wacc topic is kind of complex a little bit, but I started by talking about capital, right? And I said that we have two sources of capital, equity and debt. So if you go for equity, right? If you go for equity and debt, any of these two that you go for will create cost to you. So because you cannot come for my money without it creating cost for you, right? Because of the issues of time value of money. When I give you money today and you are paying me tomorrow, I need to add something to it so that when you are paying me, by the time you pay me, how much I'll receive, the value of the money will not be will not be reduced. So that is why capital creates cost. But after all, it is not every capital on this planet which creates cost. There are some instances where husband and wife will just give each other money, then you are supposed to pay me. In that case, your husband or your wife has given you, it doesn't come with any what interest, neither does it come with any other cost. But in a business environment, any source of fund that we will go for create cost to us. So it can be equity source or can be a debt source. Now, if it is equity, the cost that it is created for us is called what? Cost of equity. KE, cost of equity. If it is debt, the cost that will be created to us is going to be cost of debt. But we are saying that the student who is going to calculate Wacc needs to first of all know the formula that he's going to use for Wacc. And the formula that you're going to use for Wacc depends on the capital structure of the company. So if the capital structure of the company is only equity and debt, then you write your formula in this context as the Wacc is equal to the KE times the value of equity over the value of equity plus the value of debt plus cost of debt 1 minus T times the value of debt over the value of equity plus the value of debt. So this becomes the Wacc formula, right? But if it happens that the entity is having some preference shares, then we will have cost of equity times the value of equity over the value of equity plus the value of debt plus the value of preference. So the formula becomes a little bit long, right? After this section, I'll share with you the recorded section. You can take your time to write the formulas one by one. I want to take my time to write the formulas. Then we will have what? Cost of debt 1 minus T times the value of debt, the value of equity plus the value of preference plus the value of debt. Then I come to the third one. The cost of preference shares will be the value of preference shares over the value of equity plus the value of preference plus the value of debt. So here you could see that because there's preference shares, we have three items in the formula. You could see that we have three items in the formula. We have the cost of equity side, we have the cost of debt side, then we have the cost of preference. So you only use the second formula. You only use the second formula if the entity is having these three sources of funds in their capital structure. If not, then you are supposed to use just the first one. The first one is when you have only equity and debts. Then you have to use that. So on the day of exams, what is important is that you need to know the ways of calculating cost of equity. Now, the ways of calculating cost of equity is what the examiner is going to give you in the question. He's not going to tell you that maybe Salembe, this information in paragraph 2 is what you're going to use to calculate cost of equity. then it's like the examiner has come to the exam hall to whisper that information for you to know how to answer the question. Which examiner will do that? No examiner will do that. So you need to know that when the question is given to you, this aspect of the question, the paragraph, maybe paragraph 6 is going to be used in calculating cost of equity, paragraph 1 is going to be used in calculating cost of debt. You need to know that. Nobody will tell you. If you say you have learned, you should know that information of CAPM is here. Information of so and so is here. You should know it. And that's why we are saying that you need to master what you are learning. So this is the work formula, right? So you're going to take them one by one, right? You're going to take them one by one. So the first one is our friend here, which is KE, cost of equity. So we are saying that what are the ways of calculating cost of equity? So say cost of equity calculation, right? So with cost of equity calculation, we said that we have two main methods of calculating cost of equity. So one of them, the examiner will give you in exams, but we don't know which of them he will give us in exams, but you should be ready for any of them. So you can calculate the cost of equity using the dividend growth model, or some call it dividend valuation model, right? Then we can calculate KE also using the capital asset pricing model. Now, what is the formula in calculating KE when it is dividend growth model? So we say that KE is equal to DO 1 plus J all over PO plus J. Now the question is, how do we get this DO? How do we get this DO? This DO is the current dividend, and this J is the growth rate. Then this PO is the ex-div share price. So these are so you need DO, J, and PO. DO, J, and PO. These are the three things you need in calculating KE using the dividend growth model. But this J that is here, so that is where the complication starts. This J also that is in this formula of dividend growth model, the examiner may decide not to give you the J. So if he decide not to give you the J, for the KE, we are done. It ends here. This is the formula in calculating KE. It ends here. But what if he doesn't give you the J in the formula? Then we said that the J can be calculated using one, Gordon's growth model. Gordon's growth model. So we pray that on the day of exam, he gives us the J. But if he doesn't give us, we need to know how to calculate it, the two ways to calculate it, right? So the J is going to be B times RE. Now, what is this B? The B is the retention rate, or the part of the profit retained. So the examiner normally gives you the portion of the profit paid, the dividend payout ratio. So the portion that you have paid out dividend, the remaining portion is the portion that you have retained. So if we're having 100%, right, the total profit after tax is 100%. And if the entity has paid 45% of this as dividends, then the remainder, which is 55%, is the retention rate, or the part of the profit retained. And that is the B. This B is the part of the profit retained. So we just put the 55 here. Then we will wait for RE. What is RE? RE is the return on investment. So we need to get that RE here, multiply it by the 55%, which is the B, the retention rate. Then we will now get our J. Then we just come and put the J here and here. Then we calculate our KE. But what if the examiner wants you to still calculate the J, the growth rate, and the growth rate, he doesn't give you the Gordon's growth model. You can't see the Gordon growth model figures of the retention rate in the case study, in the question. Then you can use what you call the averaging method. The averaging method. The averaging method. And the averaging method says that J is equal to the current dividend, the most recent dividend, right? So let me just use this current dividends. That's what makes students understand over the very old dividends to the power 1 over n minus 1. So normally you use this j when the examiner gives you dividend 1, dividend 2, dividend 3, dividend 4, and immediately you see these ones that he's spreading the dividends for you. Know that you need to calculate the j using the averaging method. Under Gordon's growth model, he will not give you the dividend that they paid in year 1, year 2, year 3, year 4. Because nothing of the formula needs those dividends paid in year 1, 2, 3, 4. But when you see that the examiner is giving you dividend 1, dividend 2, dividend 3, dividend 4, that means that he wants you to calculate the J using that information. And that's why he has given you that information in the question. So when we come to KE calculation using the dividend growth model, oh, I thought I've actually lost you guys. I don't know what was happening to my screen, right? So I think you can hear from me perfectly, right? So when the examiner gives you D1, D2, D3, D4, the dividends, he can give you maybe 50, 40, 90, 300, 70. Then that means that he is going to worry you with the calculation of the growth rate using the averaging method. So the KE calculation is actually done using either dividend growth model or the CAPM. But we only go through the hell of the growth rate when he doesn't give us, then we either use the Gordon growth model or the averaging method. So I'm done with this formula here. Now let's come to how we calculate KE using the capital asset pricing model. So that is where you see risk-free rates, equity beta, risks on the market minus risk free. Anytime you see risk free, the examiner is talking about risk free, and that's what he likes mostly. You hear risk free, you say, because they're talking about risk free, it is KE that he wants me to calculate using CAPM. Because look at this, the dividend growth model, can you see any risk free RF in this formula? No. So immediately you hear of risk-free, risk premium. He wants you to calculate cost of equity using the capital asset pricing model. So immediately you are reading the question, then you see that in the question they say risk-free. You say CAPM. CAPM is here. So nobody should tell you that you are to calculate KU using CAPM. You should know it. Okay, so now that risk on the market minus the risk-free is what we also call risk premium. Risk premium. So sometimes instead of him to give you the REX on the market to be, let's say, 10%, then he'll give you the REX free to be, let's say, 4% for you to get 6%. He can deliberately tell you that the REX on the market minus risk free, which is called the risk premium, is automatically 6. If it is automatically 6, do you now have to go and ask the question? For me, all the time calculate it when you have to give me the REX on the market so that I subtract the risk free from it and get the 6. He has given it to you. So you pick it up and go straight away and calculate your thing and move on. So when you hear of REX free, beta, and those things, you know, CAPM, you are here. I need to calculate you. When you see that the examiner is giving you the dividends, look at it, the dividends, the PO, then he wants you to calculate. He can even give you the growth rate itself, or he may not give you the growth rate itself, but just like the assignment, he has given you some dividends, Then you know that I need to calculate the growth rate. Then the growth rate, am I going to calculate the growth rate using the Gordon's growth model, B times RE, or I'm going to use the averaging method? So you need to know. You need to know. The examiner, no examiner will come to the exams and tell you, you see this paragraph. This paragraph contains information of calculating cost of debt. Nobody will come there and tell you. If you say you are studied, if you say you have learned, right? If you say you really burned the midnight candle, you were not sleeping, and you were doing a lot of learning to pass, then when you see that paragraph, you should know that that paragraph wants you to use this formula to calculate those figures there. So that is it. So the first one I've touched on is KE, calculating KE in the formula, where you can calculate KE using the dividend growth model or the capital asset pricing model. And the G, he may decide to worry you with the G using either the Gordon's growth model or the averaging method. Then we can say that this KE here is dead and gone. We know how to calculate it. Then now we come to KD, right? KD, the cost of debt. Now this KD1 minus T is telling us that this is cost of debt after tax. When anytime you see 1 minus T, that means that you have subtracted tax from it. So there was one assignment that I gave to some group of students where I gave them the after tax cost of debt, and they still came to subtract tax from it again. If the examiner tells you that the after tax cost of debt, okay, the after tax cost of debt is 8%. When he said the after tax cost of debt is 8%, he's trying to say that KD1 minus T is what is 8%. Because when you see 1 minus T, that means you have taken tax from it. And if the cost of debt is after tax, that means that you don't have to come and subtract tax from the 8% again. Unless he tells you that the cost of debt is before tax. Then now you can now come and slot your 8 here and now say 1 minus T. Because he said the cost of debt is before tax. Before tax means he has not taken tax from it. So the one writing the exam take tax from it. But when he say it's after tax, that means he has already taken tax from it. Don't go and take tax again from it. There's going to be what double taxation if you try to do that. So I'm done with KE. I'm coming to KD. Now we have made it clear, and I'm emphasizing it again, that your examining team all the time want you to calculate cost of debt, KD, using internal rate of return methodology. Now, internal rate of return is an investment appraisal technique that we will learn later. We said that you can calculate internal rate of return when you have two NPVs and two discount factors. You can only calculate internal rate of return when you have two NPVs and two discount factors, right? So we all the time recommend that you use the table. So students who have not mastered the table are the ones who are going to be in trouble on the day of exams, because honestly they are even struggling to even know whether the information here requires the use of that tabular format, right? They can't even see, right? They can't even see. So a minute to respond to. Okay, so just give me a moment. I just need to respond to. Okay, so we need to master out the table, right? So we come here and say, you can just say item. I just say item here. It doesn't matter, right? Then we'll have the cash flow, right? Then we'll have the discount factor, right? Then we have the present value. Then we come out with another discount factor here. Then we have the present value. I want you to master this table. So cash flow is here. We have the present value 1. We have the present value 2. Can do that. Now, here I've indicated that the student is the one who is supposed to predict the percentages. So it tends out to see some students use 5%, then they use 10%, or 4% and 5, or 15 and 20, right? So if we are using the tabular format, we all the time start with year 0. Now the figure in year 0 is the market value, which all the time we put it in what? Negative or in brackets, right? Then because all the discount factors are in year 0, in our recorded session we said that any discount factor in year 0 is automatically 1. You don't have to come and calculate. So the discount factor of 5%, 2%, 100%, 6%, 44%. So for us, it's in year 0. It is 1.00. You don't have to calculate. All the time, we want you to leave it to 3 decimal place. So we'll say 1.00. Let me say that here is 98. So in that case, negative 98 times 1 will give us negative 98. And here, because the discount factor is 10%, it will still give us 1. So I'll still come and pick that negative 98, and it will still give me negative 98 here. Is there any confusion before I proceed? Please, when you come here, feel free and ask your question.
Yes, Elder.
Yeah. Hello.
Yes.
Hello. Okay.
Yeah, so let
If
Kofi
you
go
can come
first.
again,
Let Kofi
if you
go
can
first.
come again, I don't understand well the process here.
You said if I can come again.
Yes, yes.
Yeah, so we are trying to look at how to calculate cost of debt using the internal rate of return method. And we are saying that with internal rate of return method, you need 2 discount factors. So over here, the discount factor we are choosing is 5% and 10%. So we are saying that if you have a question where you are using the internal rate of return methodology, the examiner is going to give you the market value of that debt or bond, and that is what you put in year 0. So you just put 0 here, then you say question, where is the market value? And you see that in the question the market value is 98. You put it here, 98. But because it's in year 0, all the time we put it in brackets. Then what is the discount factor? 5% and the 10% in year 0. It is 1. So that's why I wrote here 1.00 here. Then if I'm multiplying, negative 98 times 1 will still give me negative 98. Then because also the discount factor of 10% in year 0 is also 1, I'll now still come and pick this 98 and multiply this 1 also. Then I'll get this negative 98 here. So the first one was to pick this negative 98 and multiply this 1. Then I got this negative 98. Then I picked the same 98 and multiplied the second one, and I got the other negative 98. Is that okay, Kofi? So the 98 will be given to you in the question. It may not be 98 every time, but he will tell you in the question. Hello, Kofi?
Hello. Hello.
Yes,
Yeah,
Kofi?
Elder. Yeah, Elder, it's okay now.
Okay. Yeah, good
Thank
question.
you.
Okay.
Good question.
Yeah.
That of
Hello.
I think Agabus.
Yes.
Yes.
Okay. I've not well understood. Okay. For example, you put like 5% and 10% at present value 1 and 2, but I don't know what is it about? How do
All
we
right.
know that is 5% and 10%?
Yeah, so I was explaining that in using the internal rate of return method, you, the person writing the exams, you need to estimate or predict which of the percentages that you are using. So I'm using 5% and 10%. Nobody will give me the 5% and 10%. Somebody can use 15% and 25%. Another person can use 8% and maybe 20%. So Bello here, it's not that maybe the question is what it will give you the percentage, but you, the person doing the writing the exams, you need to determine what percentages you're going to use. So it will not necessarily be that it is going to be the same percentage. No, we are interested in the principle, right? So somebody will just say that, Henry, what if I finish and I get my answer to be 2 and another person get the answer to be 3? We said, don't worry. We are marking and we want to know the principle, whether you have exhibited the principle. That is what you're interested in. So please feel free and predict your percentages. Don't let anything hold you. Any other question
Okay.
before I move on? Please feel free and ask your question, right? But we are going to use this one to solve some few questions. Then, if it happens, so I'm creating scenarios here. So not that I have a question in front of me. Don't get confused. So if it happens that the question tells you that the bond is maybe a 4-year bond, if it is a 4-year bond, then the second thing that you're going to do is that you come here and say 1 to 4. 1 to 4. So that 1 to 4 is telling us that this is the side where we are going to pay the interest. So year one, you pay interest, year 2 interest, year 3 interest, year 4 interest. Then also on the 4th year, you only pay principal. So you see how I brought the 1 to 4, because this side is interest payment. The 4 here, is when we are paying the principal on the 4th year. So at the point where you are paying interest, know that you are not paying just 1 year interest. You are paying interest for 4 years. And that means that we cannot use discount factor. Instead, we need to use annuity factor, because annuity cash flows is when you have the same cash flows for several years. So if we're paying the interest year 1, year 2, year 3, year 4, 4 years, you cannot talk about discount factor. Instead, annuity factor. We only use discount factor when the interest is paid for only 1 single year. But if cash flows are repeatedly for more than a year, we don't use discount factor. Instead, annuity factor. So let's say that you are paying an interest of, let's say, 6%. So if we're paying an interest of 6%, it is going to be after tax. Okay, you follow, right? It's like I'm building a story. When you try to follow what I'm saying and we pick a question, you are going to be okay. So if they are paying the interest of 6% and we have a tax element of, let's say, 30%, right? At the end of the day, it's going to be 6. Forget about don't worry yourself about the calculation. I'm giving you the calculation, but just follow the story. So if they are paying an interest of 6% and their tax rate is 30%, at the end of the day, we end up getting what? 4.2. 4.2. So this 4.2 is what will be the interest that we will pay year 1, year 2, year 3, year 4. So you put the 4.2 here. Do we all understand how I got the 4.2? Can somebody tell me if he or she is fine?
Yes, you get it.
Okay.
Yes, yes.
So if you understand that, then we are paying the 4.2 for year 1 to year 4. So we don't need annuity factor here. We need we don't need the discount factor here. We need the annuity factors. This side here, we need the annuity factors. When we get the annuity factor here, we multiply the 4.2 here and the annuity factor we get here, then we get the first figure here. Then when we get the annuity factor here, we will use this 4.2 to come and multiply it, then we get the answer here. So that is what we are trying to do. So now that I've gotten to this side, right? Now that I've gotten to that side, I'm interested in what is the annuity factor of 5%, because the discount factor is 5% here. What is the annuity factor of 5% for 4 years? And that is where I was saying that if you cannot do the calculation, The annuity factor table is there where you can just go there and pick it. Right? You can just go there and pick it. Let me see if I can get it. Then we'll use it. But at the end of the day, I'm interested in showing you how we can calculate it. So I'm trying to move in and see where it will be. Just give me some moment. I'll show you where it is. So I'm going to share my screen. Hey, good. So I'm there now. So let me share my screen. I don't know if you can see it. Sometimes you can see it. Let me share. So this is what I was talking about. Let me take this item from here. I hope we can all see now. Can we see?
Yes.
Okay. So if you can see, then that's good job. Okay. So we are looking at this, the annuity table, because you are paying interest from year 1 to year 4. 1, 2, 3, 4. So it is multiple cash flows that you're going to pay, multiple interest, cash in cash flow. And that's why we need annuity factor, not discount factor. So you come to the annuity factor table. At that point in time, we are looking at 5% for 4 years. So that is going to be this. So 3.546 for the 5% for 4 years. Then we need the next one, 10% for 4 years. So you just come here and read it. Right? So that is 3.170. Then we pick it. Who is having challenge with how I did the reading? 5%, then you trace 4 years. 10%, you trace 4 years. Who is having a challenge? Any challenge? Please feel free. So if there's no challenge and nobody's talking, then we put here 3.546. Then here we put here under the discount factor, right? We put here 3.170 because we have looked at the 5% and the 10% for the 4 years. So at the end of the day, we now multiply and put the answer here. For the 4.2 times 3.546, you put the answer here. Then so what is the answer? Can somebody give me? 4.2 times 3.546. Please just use your calculators and let's move fast, right? Hello, can somebody help?
Yes, it is 14.8932.
14 point.
89.
So we have 14.89. Just put it in that context.
Yes.
Then, so guys, you saw the two things that I'm combining. So I multiply these two things here. The 4.2 here and the 3.546. Then I'm now going to multiply the 4.2 here with this figure here, 3.170. First of all, I multiply this 4.2 by this 3.546 and I got this figure 14. Then I'm going to pick this 4.2 here and use to multiply this 3.170. What answer would we get?
Seven.
4.2 times 3.170. Please, all of you have to get yourself involved. Not that some people will have calculators. Calculate it also and check. Right?
13.3.
13 points.
3.
13.31.
Okay. Okay, so maybe 31 here. That's fine. Then now we come to the 4th year. The 4th year, note that the 4th year we are only paying the principal once. So here we can't talk about annuity factor because we are paying it just for just one single year. So we need the annuity factor of the 5% on the 4th year, and the annuity the discount factor of the 5% on the 4th year, the discount factor of the 10% also on the 4th year. But how much are we going to consider as the cash flow? So normally the examiner will tell you that at the 4th year that you are paying for the bond, sometimes he will tell you that it is going to be redeemed at par. Please, let's have to be mindful of that statement. On the 4th year that you are paying the principal only, he can tell you that it is going to be redeemed at par. If it is redeemed at par, then you put 100 here because par is 100. But there's some instance where he will tell you that it will be redeemed at a premium. So if he tells you to be redeemed at a premium, then you put the premium value here. So sometimes they say to be redeemed at a premium of 102. You put that 102 there. Sometimes he will tell you that to be redeemed at par. Then in that case, you just put your 100. So please let us be mindful. Sometimes he can also say to be redeemed at a discount of 98. If you remember, I said that when the bond is sold at 100, it is sold at par. When a bond is sold below 100, we say that it is issued at a discount. For example, if it is sold at 98, we say that it is issued at a discount. If it is issued above 100, say 102, we say it is issued at a premium. So whatever he tells you at the maturity date is what you put here. Then we need the discount factor of that 5% on the 4th year, right? So that discount factor of 5% on the 4th year, let me just go to the discount factor table. So let me share my screen on the discount factor table. I am not comfortable when students are using the table, but however, I will show you also how to do the calculation. So 5% on the 4th year, right, is 0.823, and 10% on the 4th year is 0.683. 0.823, 0.683. So here you just come and read. Please, I'm not using the annuity factor table. This one is the discount factor table or the present value table. For individual cash flows, which is paid once, we need the discount factor table. But when the cash flows are paid more than 1 year, then we need the annuity factor table. I think I've explained that. So here, we got it to be 0.823. Here we got it 0.683. So what is 100 times 0. So here this is 100. You multiply by 0.823. You should get something like 82.3. Then here is 100. You use it to multiply 0.683, right? Then you will get here 68.3. Okay? So at the end of the day, you sum up all the cash flows that are here. Watch it. You sum up all the cash flows that are here. You sum up all the cash flows that are here and put your answer. So here, what is the answer? Here, what is the answer? So what is negative 98 plus 14.89 plus 82.3? You put your answer here. Then somebody should do negative 98 plus 13.31 plus 68.3. Somebody should also do that. And let's see the answer we are getting. Can you give me the answer? I want to proceed to some point before I'll close my bag and move to the airport. Hello?
Negative 16.39.
Which side? The last
Negative
one.
98. Yes, the last one.
Negative 16 point.
39.
39. Good. So negative, so put it in bracket. Now, who is doing the negative 98 plus 14.89 plus 82.3? Who is doing that?
The other would be 0.81.
0.81. Okay. So now that we have this, right? So this one turns out
So
to
I got,
be just
please,
hello.
I got
Uh-huh.
I got
Uh-huh.
negative 0.81.
Negative
I don't know if,
0.81.
yes, I don't know if I did it right.
No, if it is also
Negative
negative, please.
98
Uh-huh.
plus 14.89
Yes.
plus 82.3.
Yes.
Yes, that's what I got. I got
Oh,
negative
yes, it's a
0.81.
negative.
It's
It's a
negative.
negative.
Okay. So
Yes.
this one becomes like the MPV1, and this one becomes like the MPV2. Okay. So at the point where the MPV is 1, that discount factor over there was 5%. And here the discount factor was 10%. So we said that in calculating internal rate of return, we need two discount factors and two MPVs. So the two discount factors are the 5% and the 10%, and the MPVs are the negative 0.81 and the negative 16.39. And that's what that you need. And the formula of internal rate of return is the lower rates, right? The lower percentage or rate plus the NPV of the lower rates all over the MPV of the lower rate minus the MPV of the higher rate, right? Times the higher rate minus the lower rate. Okay? So what is the lower rate? 5% and 10%. Which of them is lower? It is 5%, isn't it?
Yes. Yes.
Mm.
Then the higher rate and the lower rate is 10 also minus 5, isn't it? I'm
Yes.
Yes.
doing this side. Then I'm going to do what is in the middle. Now, what is in the middle is the MPV of the lower rate. So we say, question, where is the MPV of the lower rate? It is negative
Negative
0.81.
0.81.
Then you start again because this also is talking about the MPV of the lower rate. So also negative 0.81 minus. So this is the minus. And again, what we are going to subtract also minus again. Okay? So that will give you
Mm.
16.39. But wherever minus meet, it becomes what? Plus. In mathematics, minus meeting at the same
Yes.
time becomes plus. So if you think calculation is going to be a problem, put it on your formula on your calculator, then let it give you answer. But what you do is that the easy one is that here is 5%, it should be there. You do what is in the bracket here. Then this side is what? 10 minus 5 is still 5. So now
5.
do what is in the middle for me. Negative, I'm talking about what is in the middle. That means I'm talking about this one. Negative 81 all over negative, negative 0.81 all over negative 0.81 plus 16.39. What answer will we get?
Please, I'm getting negative 0.051. No, 52.
Negative 0.052.
0.052.
Okay. So that is it. So what answer are we getting? So 5%. Sorry. I need to write it well so it doesn't create confusion. 5% plus what is negative 0.052 times 5?
Mm.
Negative 0.125.
So it is negative 0.125. So what is 5 plus? So please don't put this one in percentage. I've seen, don't put it divided by 100. I've seen some other some students when they are calculating, then they convert this 5 over 100. Please don't do that. Take it as an absolute figure 5. So at the end of the day, it's like saying 5 minus when positive and negative meet become minus. So minus 0.125. This is how it will become. Don't change this one to 100 and make it 0.00. Don't do that. If you do that, when you finish, we have to multiply by 100. We don't want you to stress yourself, right? So this one should give us maybe 4 point what? 875.
4.875.
Good. And so this is the percentage. And this will be the cost of what? Debts. Cost of debts. So for financial management and the paper that you are looking at, please, we are building you. You are an accountant. Accountants love numbers. Accountants love numbers. So don't run away that you are seeing the numbers as like you are running away. You want it to be changed to English. No, don't say that or don't do that, because this paper is financial management and the financial manager deals with figures. And it's part of the papers that we need to pass it before we get there and say we are a chartered accountant. So we cannot say that it shouldn't be how it is. So we want you to just look at though the challenge and try to master what you are learning. So that ends it for the KD. Yeah, right? So we are done with also D. And because we have already taken care of tax.
Sorry.
So, yes.
Yeah, hello.
Please, I don't know if they calculate the computation. Is it negative 0.025 times 5?
Which side?
Yeah, this one, the one in bracket.
Yes, you multiply. It's bracket means time. You can you see this times here?
Multiply by
This
5.
times
But
here.
me, I'm getting negative 0.26. Oh, I don't know.
No, then your calculator has approximated it. So you have to check
Okay.
the calculator that you are using.
Okay.
You have to check the calculator. Some calculators convert it to just 2 decimal place. So they will run it off for you. Get the scientific calculator. That's a scientific calculator. Get it. Buy it early. You have to buy it early. Don't wait till the exams and then you will be using your phone. Then anything calculate in class, because it's not face to face. You put your phone somewhere, then calculate there. No, you are not helping yourself. It's that the tool that you are using to study is what you have to use it to go and write the exams. So that it's like you are familiar with the what with that tool, right? But if you are using your phone in the learning state, when you get to the exam hall, will you go there with your phone? Some people use the phone and they become so much familiar about with the phone that they know how to use the phone to do every calculation. But on the day of exam, you are not going to use your phone to go and do the calculation. So what you are going to use on the day of exam, start using it whilst you are learning. So cost of debt is also done. Yes, Bello?
Hello, please, Henry.
Yes.
Yes, I wanted to ask for concerning the table of, I don't know if it's discount factor. Will we have it, or we have to keep it in mind, because there are a lot of values. So I don't know. Is there a way to know
It is
exactly?
actually provided. It is actually provided, but we do not know when you need to calculate it yourself. Because mind you, colleagues, we are actually going to proceed from here and look at the further paper with regards to this. So I don't expect you to all the time say that they should give me, but what they'll give you, and when they give you can use it. But don't be happy. Don't be that person who say, oh, they will give me, so I don't care about the formula. Don't do that. So if you want to calculate the annuity factor of 5%, right, for that 4 years, so say for 4 years, annuity factor formula is 1 minus into bracket 1 plus r to the power negative n o over r. You see these things that you are thinking that they are complex. I tell you, if you write these formulas one by one in your formula book and every day repeatedly before you start the day's activities, like you revise it, it will not take more than 2 weeks, and this thing will be in your head. You will be surprised. So and it was the same thing. Please note that it's not only you who has gone through this thing. Last time I was telling you that we are having people who had third class and pass, who have been able to now pass financial management. So you don't see these ones to be so much threatening. What you have to do is that you need to write the formulas down and be revising it daily. That is all that is needed. But don't say that too much formulas and don't say no. Please, the complaint will not bring any pass. If complaint will bring pass, some people have passed long time ago. So we need to really approach it, be pragmatic, face our problems, right? So that is it. It's just like those guys or those men who have been drinking, thinking after they drink, the next day their problem is gone. So you have to face your problem. Don't run away. So 1 plus R here. So here the discount rate is 5%. So 5%, you say 0.05 to the power -4 because the N is the number of years, all over R, which is 0.05. You can do this calculation. You see that you get the same answer that we got for the annuity factor that we read from the table, right? But I know that this is challenging to some students. So for them, please know that for me, it is challenging for me and I'll take it one by one, but I also get it, right? Yeah, all hands are not the same. Some people get it fast, others take time. So let's proceed. So this is the formula that we are using to calculate annuity factor. So the annuity factor of 5% for 4 years that we got there. This is how we could have calculated it. 1 minus 1 plus R to the power -N all over R. So you ask the question, where is the N? The N is the number of years. How many years? 4 years. What is the R? The R is the rate. And what is the rate first? The first rate was 5%. So I put 0.05 there. The next rate was 10%. I'll put 0.10 there. I just say calculator, give me the answer. I'll be coming to the Togo
I have a
office.
question.
I'll be meeting those in Togo and Cameroon. I'm interested in you, how you are going to put this one on the scientific calculator. So I'll show you when you come in the face-to-face section. Yes,
All right.
Eliezer.
Yeah, Henry. Yeah, my
Yes.
question is, the formula of the annuity factor and the one of the discounted factor is different.
Yes.
Uh,
Yes.
uh,
I'm going to give you that.
the the n we don't bring minus in front of the n, and I want to understand why.
Yes. Because we actually bring the negative here in terms of the N because we are compounding based on the numerous years that we have. So that is why we decide to put to the power N. Now, do you know that this thing can be written? I don't want to sound so much mathematical, but do you know that this formula here, this formula, talk about this formula, can be written also as, look at it, 1 plus R to the power -N. You can also rewrite it like this.
Yes.
Right. I don't want to sound so much of calculus, but that is what we are actually bringing here. But I don't want to go there. Already the formulas are scaring some of us. So if I take to look at those things, it creates problems, right?
Okay. It's okay. Thank you.
So I want you to give me the answer here. But if you want to calculate discount factor, this is we only talk about discount factor when the cash flow is just for a single year. But we talk about annuity factor when the cash flows are for multiple years. Right? So what answer are we getting for the first one? Hello?
Please, I have the second one now. Can I give it to you then calculate the first one?
Yes, give me.
For the 10%, I had 3.1698. 169.899. Yeah.
3.169. So that
Yes.
is why we approximate it to 3.1. Oh, no, which one are you saying? Is that 3.16168?
The 10%.
Uh-huh.
It is
3 point,
3.1617.
so we approximate it to 3.170, right?
Okay.
Then the first one. So you see, it's the same figure that we use, that 3.17 is the same figure that we use here. Check it. It's the same figure that we use here. So the table can give you straight away, or if you want to calculate. So the second one, I want you to tell me that is 3.546.
Yes, 3.546.
And so that is the answer that we got there, 3.546. That's all. So I've explained how to calculate KD. If you know how to calculate KD, you are in good shape because the examiner knows that no, people are going to struggle. So now the cost of preference is the next one. Cost of preference. How do you calculate cost of preference? So cost of preference, we say I over PO, right? Normally you can just multiply by 100. It gives you, right? Good. So that is it. The I here is the coupon rate, and here is the share price. They multiply by 100, you get your percentage. The I is the cost of preference is simple. You don't take it and say, everything should be like that. But if everything is like that, this will not be a professional exams. Professional exams needs to be tough. So you need to psych yourself. And don't expect, when you are going to the exam, please don't be expecting things to be easy, because getting the chartered accountant certificate is not easy, right? So guys, I've showed you how to calculate the KE here. I've showed you how to calculate the cost of debt after tax. I've showed you how to calculate the cost of preference shares. Now, how do you calculate the value of equity, the value of debt, and the value of preference? Normally, the examiner gives us the value of these preference, the value of equity, and those things. But what if the examiner does not give us the value of equity? How do you calculate it? It is going to be the number of shares times the share price, or the price per share. Price per share. Right? Then how do you calculate? So you need to go through the question and know the number of shares. So you use the number of shares times the price per share. You are done. You get the value of equity. But what about the value of preference? It's also the same. Number of preference shares times the price per share of a preference share. But how do you calculate the value of debt? The value of debt, sometimes the examiner will give you the quotation, the price quotation, to say 102 point maybe 40 at par. Then use it to multiply the book value of the debts. Please, this side is very important to me. It's not that every time he will make it 102.40. He can give it to you at 98 point something, 99 or 97, or 103.4 or whatever. But he's going to give you the quotation, the bond quotation. It will be the question, please. You will not be the one to calculate. He will give you. So the bond quotation, and you multiply by the book value of debt. Please, what do you mean by book value of debt? The value of the debt in the financial statement. So he will intentionally give you a financial statement extract. Under the liabilities, you see debt, loan, bond over there. That value that you see in the financial statement is the book value, the value in a book. But we want the market value of the debt, not the book value. So we need to convert the book value to the market value. And that's why we tend to use the current quotation to adjust the book value to get the market value. And the quotation is not your problem. On the day of exam, he will give you. So these are the ways that we can calculate Wacc. These are the ways that we can calculate what? Wacc. These are the ways that we can calculate Wacc. Is there any question? Hello? Please ask me questions, right? Before I start asking you questions.
My question is, will you talk about asset beta and equity beta?
Okay, so I actually see that
Like,
that one is going to be I actually see that that one is going to be another issue that I'm going to look at. But let's get answers. So, Kwesi, Eliezer, I'll come to your question. But let me find out if our colleagues are having questions with regards to what I've presented so far before I move on to that, because that is where another
Okay.
complication will set in. So let's take our time for now and let them ask their question before we go to asset beta, equity beta. Please just unmute your mic and come clear, okay? Don't hide. And also note that I need to also get myself ready. So if you have question, you have it, please ask. Don't actually waste time.
So please, I have one question.
Right, ask.
When we were talking about the cost of capital, the WACC, weighted average cost of
Mhm,
capital, we
mhm,
said that it is the cost of equity, that formula. We have three of
mhm,
them. The cost of equity times the value of equity over the value of equity plus value of debt plus value of preference share. Then we do that for debt, and then we do that for preference share.
Yes,
My question is,
yes,
like the question that you gave us the assignment,
yes.
we had 4 items.
Okay.
That is with the addition one that we had was a long-term back loan.
Uh-huh.
Will we create an extra one in addition to the formula, or we have to combine some of the debt?
Good. So if there,
That's my question.
yeah, so there are some instances where we'll give you a bond, where the bond you need the internal rate of return to do the calculation to know the cost. And sometimes you also see bank loan. So what you do is that they are not the same thing. They are different. They're having different characteristics. Unless otherwise the examiner tells you that they are having the same characteristics, then you can now accumulate and put them as one and now use them for calculation. But the bonds are not the same or the debts are not the same. That's why we normally say monkey play by sizes. So that if you cannot use a 15-year bond characteristics to agree with a bank loan, they are two different things. So you have to create additional formulas or additional columns for you to use it to do your calculation, right? So that is what you are
Okay.
going to do. You can only combine them if the examiner tells you that they have the same characteristics. But if the examiner does not indicate that, there's no need for you to combine. You have to separate
Okay.
them. Right. So that's what you
Okay.
do.
Thank
But
you.
I tell you, in recent times, because this is a computer-based exam, we don't worry the students by giving the students more than three. It is just on a straight situation that we give you three. But normally it can just be two. See, the person who can do the calculation for three can do the calculation for two. The one who cannot do calculation for three cannot even do for two. So that is what we need to know. Any other question? Hello, any other question? Am I getting any question for Magabus? Any question for Eliezer, Eli, Kofi? Please ask your question. Right? Ask your question. Okay, so let me try and see if I can end with you on this good friend.
Hi,
Now,
Henry.
yes.
Yes.
Tahina, you've
Yeah,
been able to
sorry
log
I'm
in.
late.
All right.
Yeah, sorry I'm late.
You
Yeah,
you are you at Addis or you are in Nairobi?
yes, I'm in Addis. I've just arrived. It was raining,
Ah,
cat and dog, so we delayed. We stayed
okay.
1 hour in the aircraft.
Okay.
Ah,
That's fine.
um,
Yes, your
my
question.
question is, yes, I couldn't follow your this session, but I will look at the video.
Right.
I made a request about if possible to revisit the assignment that you gave us last time. If
Yes,
possible.
yes. It is one of the things that I wanted to talk about before I end the session. You know, I did not give assignments without walking the individuals through. But this work is really an area which is tough for students. There are two areas of the financial management paper which, when the student is able to go through, the student, we know for sure that he or she can, go through the entire syllabus and get it. So it is not of anything surprising that people are having problems with Wacc, because any other student on this planet who has gone through Wacc was actually having problem, especially with the formulas, the way the formulas. But if we go through Wacc, and also we have working capital management, these are the two that worry students the more in financial management. If you go through, the rest are easy to do. We will start talking about investment appraisal. You see that it is not so much challenging. You cannot compare it to Wacc, but the Wacc, the formulas are there, the concepts are there. You see, those things are what creates problems, right? So be confident.
Yeah,
Don't think
yeah,
that
Harry,
that is
my
how the
question.
remaining topics will be.
Henry, I don't know my colleagues, but as I told you the other day, is there any clue? Because as you said, the examiner may not ask that this is Gordon growth model, or this is DVM, or this is KPM. How, for us as students, how can we manage? We may know the formula, but now the practice, we may be lost. So kindly help us
Okay,
how to
so
manage it. At
understand.
least we get 50%.
No, I understand you. The issue is that you only know that this is the formula I need to use if and only if you have practiced solving questions. You see, if you have not practiced solving questions and you see that the examiner is giving you beta, you will not even know what the beta needs to be used for. But now you and I know that anytime you hear beta, we are calculating cost of equity, because the cost of equity formula using CAPM is the only place where we have beta. So immediately you see beta, you know that I'm calculating KE. So that one, on the day of exams, it is based on what you have learned and what you have practiced as a result of what you have learned. So if you have not really mastered what you have learned and you have not solved questions, then it's all the time going to be a challenge. You'll be just be reading the question and you will not see anything. It's like you are reading the question and they expect you to start typing something, but you are not finding anything to even type. In fact, you don't know how to even start, how to even end. So it comes by practice. The only thing you have to do is to just follow, go through the studies, and then when we give you a question, you give it an attempt, right? So I will not
Uh,
give you an assignment without solving it. I will look at it.
yeah, Harry, I wanted to say something.
Yes, you can.
Me, like for the formula, for me to remember, as you
Mhm,
said, when we are asked to calculate, to compute Wacc,
mhm,
if in the question, what has been given to me, I can find the elements under DGM.
mhm,
I'm sure that I'm going to use dividend growth models formally to compute the Wacc, And
mhm,
if I have elements of
mhm,
CAPIM, which falls under CAPIM, I'm
mhm.
really sure that I'm using CAPIM formula
Oh,
to
okay,
compute the Wacc.
okay,
This is what I put in mind for me not to
okay.
be confused.
Yes. So it is the
And
information of the formula that is what is going to tell you that you're going to use the formula, that particular formula.
yes,
So if you see that
yes,
he's giving you information of CAPM, then that means you need to, he's giving information of CAPM in the question, then that means you need to use CAPM. If he's giving information of dividend growth model, you need to, so you need to identify the thing before, you need to identify the thing and know which of them to use. Nobody will come and tell you that go and use this one. No.
Henry, that
my
was my
my, la- my,
question.
my last question, Erin. When
Yeah.
the question,
So
Yes, I
when the
Tahina,
believe
que-
that. Yes,
sorry.
please.
So Tahina, we have addressed your issue that you can only be okay when you have mastered your formulas and you have solved questions, because the solving of the questions is what is going to help you improve, so that you can easily see that this area, I need to use this formula.
Mm,
So that is
okay.
how it works.
Okay.
Okay,
Okay.
Kwasi, your question?
Yeah. My last question. When they said, like in the assignment you gave us, like 50
Yes.
cents, 30 cents, or 0.50 cents, I don't know. Are we going to divide it by 100, or we should leave it 50 like that?
Yes. Anytime you hear cent, you need 100 cents, 100 cents before you get $1. Okay? Before you
Okay.
get $1. So when you say here 50 cents, it is the same as 0.50. When you hear 60 cents, it is 0.60. So you divide it by 100.
Okay. Thank you.
So
And
now let me, okay, another question.
and we another question. And if in the question they give us, let's say 2016, the dividend is 5. 2015, the dividend is 3. 2014, the dividend is 2. And in the question, they gave us the value of the dividend. Are we going to use K, which is equal to DO bracket open 1 plus G, all those
Yes,
things?
that's what you
Rather,
use.
okay. Because I was
So when
like
you
a
see that
bit
the examiner
confused. Are
is
we going to
listing the
use,
dividends, like you
uh-huh,
list and say 40, maybe 50, 35, maybe 49, then that means that here, when you say dividend, you need to use that KE
uh-huh.
DO 1 plus J all over PO plus J. This is the formula that you need to use. But when you see that he's not giving you dividend, and he's talking about beta risk free, then you need to calculate this KE using this formula. Okay. So it is you knowing the formula, the items in the formula, and if it gives you in the question, then you know which formula to use. I hope you get
Okay,
it.
good. Thank you. Yeah. Yeah.
Yes.
Agabus, are you fine? Agabus?
Oh, yeah, yes, it's okay for now. Yeah, thank you.
I think I'm going through a complex area. You know for sure that KE is equal to risk free plus equity beta, risk on the market minus risk free. And I explained that a beta measures the systematic risk of the organization. But this type of beta can be two forms. We can have asset beta and we can have equity beta. Right? Listen to it as a story. Now, we said we have two types of betas. We have asset beta, equity beta. Asset beta is used when the company is only financed by equity. Equity beta. So you see, equity beta is rather used when the company is financed by debt and equity. Please don't get that confused. Because we say equity beta, some students think that when the company is financed by equity. No, rather equity beta when the company is having debt and equity. So all the time, look at it as the opposite. If it's equity beta, it is equity plus debt. If it is asset beta, it is only equity. Now, companies who are in the same industry have the same asset beta. But companies which are in the same industry have different equity betas. Why? Because the debt that a particular university, right? So when it comes to universities are in the same educational industry. But the debt that maybe let me just use this example, University of Ghana can go for will not be the same debt that maybe Methodist University can go for. So because the debt element, we say monkey play by sizes, because the debt elements are different. That is why equity beta are not going to be the same for every firm in the same industry. But asset beta is going to be the same because equity, we tend to float it. And they tend to have the same characteristics in the industry. So whatever happens to the holders of equity, the information that comes into the industry for the equity will affect all entities in that industry. So that is why I all the time give this example of Midland Savings and Loans, I think somewhere in 2020, when the one policeman assaulted, in fact, he actually gave that woman a lot of beatings. Beatings. This was a Ghana example. He actually gave that woman a lot of beatings. Now, that video went viral to the point that people were sometimes scared that maybe their money, when they are going for their money, is going to be a problem. It affected the banking industry. Any bank in that industry was affected. And that was when those times when you are going to the bank, you will just be raising your shoulders, because in fact, anytime there's a cough, they'll come and they say, hey, is there any problem? Because they don't want any sort of bad information to go out there to affect their business. So for asset beta, because we are the same firm in that industry, we have the same asset beta. So there are some instances where the examiner needs to give you the equity beta. The equity beta is what you need in calculating the KE. So the examiner is supposed to give you the equity beta, but there's some instances where the examiner will not give you the equity beta. But he will deliberately go and give you the beta of your sister company who you are in the same industry with. So we are talking about Eliezer company. That examiner, you are supposed to give me the equity beta of Eliezer company, so that I use it to calculate the cost of equity for Eliezer company. But he will not give me the equity beta of Eliezer company. I'll be checking through the questions, it's not there. But he has deliberately given me the equity beta of Agabus Company Limited. Then he has told me that Agabus Company Limited is in the same industry with Eliezer Company. That is to say that Agabus Company is a proxy company to Eliezer Company. They are in the same industry. Then, if they are in the same industry, then I can pick the information of Agabus and change it a little bit. Then it becomes the information for Eliezer. So we are saying that when they give you the equity beta of Agabus, right? When they give you the equity beta of Agabus, you don't need the equity beta of Agabus. You need the equity beta of Eliezer. So having the equity beta of Agabus, know that this equity beta of Agabus contains debt and equity. And because the debt is what is different from the Agabus and Eliezer, you need to take off debts out of the equity beta of Agabus, so that when you take debt out of the equity beta of Agabus, you are only going to be left with asset beta. So I took the debt aspect from Agabus equity beta, then I'm only left with what? Asset beta. So now that I'm left with asset beta, this asset beta is the same for every industry, for every entity in the industry. So that means that the asset beta that I've gotten for Agabus is going to be the same, is going to be equal to the asset beta for Eliezer. But the equity betas are different. So you have to strip debt out of the equity beta so that you get the asset beta, which is the common thing to these two entities in that industry. Then now, I'm now going to add the debt aspects, debt of what? I'm now going to add debt of Eliezer to now get the equity beta of Eliezer. So this is what the examiner brings, and it is a problem. But I tell you, even if you cannot go through that application, you will still get your pass. You will still get your pass. But the problem will tend to be when he brings it in part B. That is where the problem will be. Then he really wants you to get the equity beta of Eliezer, but you check through the question. Friends, there's no information of equity beta of Eliezer. The company is Eliezer company, And that is what you are solving the question on. But you can't see any information of equity beta of Eliezer. But he has deliberately given you the equity beta of Agabus. I say, do I need Agabus? I don't need Agabus. I need Eliezer. So why you give me information of Agabus? Oh, but when I take debt of out of Agabus, when I take debt out of Agabus, what will be left will be the same as that of what Eliezer. Then, because debts of Eliezer and Agabus are different, I can now say that if the asset beta are the same to you guys, then Eliezer, bring your debt and let me put it in the asset beta. Then I get the equity beta of Eliezer. So you're using one thing to find another thing. And when we are taking debt out, that is when we say degearing. Degearing. Don't let the name scare you. Degearing means taking the gearing aspect or the debt aspect out. And bringing back the debt is where we say what? Regearing. Regearing means bringing back the gearing or bringing back the debt or putting in debt. So this example is what I explained in Fence Code. There's one recorded section called Fence Code. After this, if you have understood this side, you can go back and listen to Fence Code solution again. Listen to it maybe 2-3 times. Listen to it maybe 2-3 times, and you're going to be fine. Any question for me? I think I'll take 1 or 2 questions, then I'll end the class for now. But I'm going to call on my colleague Cedric. There are some few questions that me and him we are going to discuss them before he will come and meet you and walk you through. Then I will meet you and solve the remaining questions that I give to you as an assignment, which I've not solved with you. So I'll do that before I'll now think of jumping into investment appraiser. My next topic will be investment appraiser, but I want to spend some few time on Wacc because it's complex. So the next topic is investment appraiser. That one is friendly. That one you don't see people complaining, right? So do not think that all the topics are like that. There are some small boys in there, and I tell you, the investment appraiser is also where you get a lot of questions from. That is the one that is not also much difficult. It's difficult, but not so much difficult like Wacc, where we have a lot of formulas, right? But it's a little bit also complicated, but not too much. So people who
Henry,
are learning investment appraiser are all the time okay with investment. I mean, people who are learning to write financial management are all the time okay with investment appraiser. But for Wacc and working capital, that is where you see them. It's like they're shaking. Yes, Tahina?
yes. All these formula have to be known by heart, isn't it?
Yes.
Am I right?
So, yeah. So if you want to calculate asset beta, it's equity beta times the value of equity over the value of equity plus the value of debt,
Yes,
1 minus
debt.
t.
Mm.
Then if we want to calculate equity beta, it is asset beta. It is not difficult. I'll show you the easy way to remember. So you see this one, this denominator here,
It
now
will
will
go.
become the numerator.
Mm.
We just turn it upside down.
We still
Okay?
continue to do mathematics.
So the one down
Yes.
is when we are re-gearing,
So this
right?
one is when you are doing the re-gearing,
Yes.
putting
Okay.
back the
Which
debt.
one? The second
And
one
this
or the
one,
first one?
the first one is when you are de-gearing, taking the debt out of it.
The gearing.
So know the formula. It is just writing B-A-B-E, but what is important is you flipping the numerator and the denominator here. Here it was
Yeah.
VE. You see this one, which is the numerator, the upper one. Here become the lower one. And here, which one is the
Mathematics.
lower one became the upper one.
Yeah.
You get it?
Maybe my last request. Will it take time to upload this video also? Just when we finish the session here, we will be able to revisit on the video, and then we do practice